Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, it has been a big week for the crude oil prices where we have seen $80 being hit for the Brent crude oil prices. This has been a 4-month highest for the Brent crude oil prices. As the 4th November deadline for the Iran sanctions comes closer, we have seen the Iran exports actually continue to decline. The Iran exports are lowest since March 2016. We have seen nearly 28% of a decline as far as the Iran exports go. It was at 2 million barrels per day in the month of August, which I said is the lowest since March 2016. Well, the Iran shipments to other countries have also taken a hit at about 28% since April 2018. The ongoing crisis in the emerging market, trade war dispute and depreciating global currencies has also impacted the oil prices. Not just that, while the International Agency has warned of supply tightness, the global oil demand is expected to breach 100 million barrels per day in next 3 months. To discuss this and more, we are now joined by Azlin, Ahmad, Pugh and Amrita. Gentlemen, hi, thank you so much for joining us. Azlin, starting with you first, and what a week it has been, because $80 per barrel has been a resistance for some time, but we did see that level come into this week as well. Of course, there has been some resistance at those levels, but what is your sense? Once 80 is done, are we really headed further higher from these levels?
Well, I think that for the crude oil prices, we've seen quite a strength in the crude oil prices this week, and a lot of it is hinges on Iran, because what we've seen is that a lot of the countries, especially in Asia Pacific, have started to reduce their imports of Iranian crude without the promise of a waiver from the US, and I think that that will continue. So that's been a big factor that has pushed Brent up closer towards the $80. And WTI is hovering between the $69 to $70. So Iran is still a big factor in the market. And of course, Venezuelan production continues to be quite limited right now, and that's another factor.
Thomas, coming to you as well, what is your sense? With the 80 done now, the markets really seem to be preparing for higher prices from here, and that's exactly what we have seen in sense of various international bank reports as well, where they are predicting the crude oil prices anywhere to 90, 95. There's a report out on a 3-digit number as well. What is your sense?
Well, it's worth noting that we only very briefly went above 80, by a couple of cents for a few minutes. So and then we've fallen sharply back. We've fallen $2 back almost immediately. So I don't think it's clear that 80 is the kind of the new norm. We've seen prices bounce between 70 and 80 over the last few months, and I think that's likely to continue. The market seems to have priced in most of the reduction from Iran. So unless we see a significantly larger fall than expected, I expect prices to continue to trade within that kind of $70 to $80 range.
Amrita, what's your sense then? Because yes, as rightly put out by Thomas, it has been a very volatile week. We've seen a 4-month highs. We saw 2% correction yesterday. We saw the crude oil prices clawing back yet again today. With the kind of volatility that we are seeing, what are the cues you're working with, and what's also your sense on the prices going forward?
Well, I think obviously there's a lot of volatility in the market, not necessarily because of the Iran factor alone, but it's also a lot of emerging market risk with, the dollar appreciating versus the basket of fragile five. There's, of course, the trade warfares with China. Had it not been for any of these macro risks, I genuinely do believe oil prices would have been substantially higher, potentially into the 90s, if not more. I think the big thing is nobody in the market really is expecting Iranian exports to go down to zero. Neither are we. But we have been more bullish than most in terms of how much we are going to lose from Iran. I mean, we believe we're going to lose 1.5 to 1.7 million barrels per day. Indications now are, including from India and China, two countries that were allegedly going to keep buying Iranian crude, that the cutbacks are going to be substantially more. So it is very possible that the Iranian exports fall below 700,000 barrels per day, which was the low point under the Obama administration. Nobody in the market is expecting that, and you can see this in the physical market. Brent's very, very backwardated. Every physical crude is trading at an immense premium. that just tells you that the only reason prices haven't reached 80 is because of other concerns rather than Iran. Once we lose more barrels from Iran, I think it's only a matter of time that prices are going to go substantially higher.
All right. So, well, that of course is the first comment from all of our experts on where this expect the prices to be and what would be that one most important fundamental to watch out for. But let's take it case by case. And Azlin, coming back to you, you know, the supply side, of course, is quite important to see right now, with most people expecting a tightness as we get into the final quarter of this calendar year, especially when it comes to OPEC, because they, the agreement that the OPEC and Russia and non-OPEC companies have done, that only lasts until end of this year. So what is your sense about supplies from OPEC and Russia now?
Well, the supplies probably, in terms of production, I think that we're going to see a period where it's going to be a very fragile balance, because obviously ahead of November, we will probably see continued decrease in Iran production. I mean, at this point, without any indications of waivers from the US, there is the possibility that Iran production or Iran exports could fall by 1.8 million barrels per day by around November from the volumes that they were exporting in May. But I think that the market is still expecting or hoping that the US will grant some waivers, so that will temper the drop in the production. In terms of supply, the IEA said in its report yesterday that spare capacity is roughly about 2.7 million barrels per day, but 60% of that is in Saudi Arabia. So there's not a huge amount of spare capacity in the market, and it's very unclear how much can quickly be brought on stream to offset the Iran drop in export. So I think in the short term, the market's going to be quite bullish until November, until there is much more clarity on the US stance in terms of what they want from Iran exports, whether they want to totally halt it or whether they will be a little bit more flexible and allow refiners, some major refiners, to at least import but at reduced volume. So I think that's going to be key in the next month, at least in terms of the crude prices.
So Azlin, in light of that, how much of a premium do you see in the crude oil prices because of the supply concerns that you just mentioned?
I think further out, we don't really see that the market's going to be that tight, because going into, I think, at the end of the year and going into 2019, if the trade disputes between the US and China and the rest and many countries continue and escalate, that will obviously have some impact on demand. I mean, at the moment, we don't think that for this year there's going to be a huge impact on in demand from the trade dispute, but that will probably be felt a lot more in 2019. So our expectations is that the market going into next year may not be as tight as we see this year, because there will be, this is assuming that Libya production will stabilize. We do think that some of the West African countries will see some steadily increased production, and some of the Middle East countries like Abu Dhabi will increase their capacity, their production capacity and their production.
Before I go back to the other experts, Azlin, I want to put this question yet back to you again. As Amrita and Thomas said, that they do not expect the crude oil prices to run away, but then just reiterating that there have been some reports suggesting a level of $90 to $95, if not this year, then 2019 perhaps. What is your own sense on prices?
I think that our expectations is that it's going to be, the band probably will stay around there. I think that unless, okay, this is assuming that Iran exports will not drop to absolute zero. I think that it's going to be a little bit hard for Brent prices in particular to be sustainable at above $80 at the mid to high $80 in the short term. So I think our expectations is that $70 to $80 is still roughly where the Brent prices will probably be, and we could see slightly lower prices in the first half of 2019 compared to where we're seeing right now.
All right, that is one thing. All three of you are on the same page. But coming to you, Amrita, the supply side is something that almost everybody seems to be getting worried about, whether it is the IEA report or it is the Russian oil minister's statement saying that the geopolitical concerns are a big risk. And then, of course, it is about Venezuela, Libya. Those concerns just seem to be getting deeper. Markets also are looking at the hurricane season, which continues until 30th of November. Amongst all of this, where do you see a major threat perhaps coming across?
Sorry, what was the last bit? Do you see a major
threat coming across when in sense of supply concern?
Yeah, no, of course. And I think, like you mentioned, I mean, the biggest issue is not just Iran, right? It's basically Venezuela, but remember also Iraq, Nigeria, and Libya. They're all pretty much producing at max of their recent ranges. If there is any other outage, we just don't have the spare capacity. I mean, I'll bring the spare capacity back into the picture over here because I think it's very important to define it correctly. On paper, we might have close to 2 to 3 million barrels per day of spare capacity. But the reality is if you define something as what can be brought online in 30 days and sustained for 90 days, I think the actual number is around 300,000 to 500,000 barrels per day. Saudi Arabia has never produced more than 10.7. It talked about going to 11 and it hasn't done that yet. They have a few expansions here and there and maybe they can expand to 11. Of course they can get to 12. Of course Russia can add another 200,000 to 300,000. But that takes time. It takes more rigs. It takes more capex. We are 9 to 12 months away from that. That's the problem. If you get another outage right now, we just don't have the global shock absorbers.
Thomas, coming to you as well, while of course the Iran sanctions is a big buzzing movement right now because we already have seen, even as the US has been talking about waivers to certain countries, we've seen certain European countries completely stop imports from Iran. Chinese imports have declined by 36%. Indian imports have gone down by 45% as well. So while of course there are other producers trying to fill that gap, what kind of a supply tightness do you think the international markets are readying themselves for?
I think the markets have probably priced in a 1 to 1.5 million barrel reduction from Iran, although it is kind of anybody's guess just how much they have. I think that we've seen Donald Trump's persistent obsession with high crude prices. And I think especially coming up to November, if we're seeing that the Iran sanctions are putting significant upward pressure on prices, if we're still at 80 or even higher towards 90, then I wouldn't be surprised if we do start to see a lot more waivers being issued, at least for the short term, to ease some of that price pressure and allow prices that US consumers will be voting in the midterm elections in November to see fall. So I wouldn't be surprised if we see a little bit of a rowback from the US.
Well, that point is very well taken. Yes, it's the elections year and they wouldn't want the crude oil prices on the higher side. But guys, please stay on with us. We will go for a very short break. When we come back, we will discuss the prices moving forward and also the demand scenario, especially for a consumer country like India, where we have seen all-time high fuel prices in much of last month.